Okay, let's dive in. I think a lot of people listening have probably asked themselves this kitchen table dilemma.
Right.
It's pretty simple, right? The U.S. government has been spending way more than it earns for, I mean, decades now, building up this massive national debt. So why don't our politicians just get in a room and fix it?
Well, the uncomfortable truth, and this is what the sources are really laying bare, it comes down to two things:
Okay.
political reality and just pure math. The politicians don't fix it because, frankly, voters won't support the solution. The fix means austerity.
Which means higher taxes, lower benefits.
Exactly. And that's political suicide in any democracy.
And, for a long time, we basically got away with it. We could just kick the can because
Yeah.
borrowing was so incredibly cheap. But that era is, well, it's over.
It is definitively over. We've hit what our sources are calling the mathematical wall.
$38 trillion in debt. That's the wall.
That's the wall, and it's climbing fast. We're past the point where you could even do traditional austerity. Think about it. If you cut spending enough to balance that budget, the cuts would have to be so deep, so immediate, you'd likely crash the entire economy.
And make the debt to GDP ratio even worse.
Worse, not better. So that escape route is blocked.
So if you can't shrink the debt, the numerator, the only way out is what? You have to grow the denominator, GDP.
You have to force radical growth faster than the debt is growing. And that's the question. How do you do that in a mature economy?
And this is where it gets really interesting.
It's this fascinating unconventional collision of ideas.
Mm-hmm.
On one side, you have that gut-level protectionist impulse of a politician, think of someone like Donald Trump, favoring big, broad tariffs.
Right.
And on the other, you have the rigorous theory of economists, specifically Stephen Miran, who looks at those same tariffs and sees something completely different.
Not just a trade tool.
No, he sees a strategic lever to legally restructure the entire U.S. debt.
So the result is this blueprint they're calling the Miran Doctrine. It's a huge gamble to force global manufacturing growth back onto U.S. soil. And that's what we're going to unpack today.
Our mission here is to really get into the three core pillars of this strategy. And, just as important, its three built-in failure modes.
Okay, let's start with pillar one, using tariffs as a geopolitical lever.
Right. So you might remember the headlines late last year about the coffee U-turn.
Yeah, the administration rolled back tariffs on things like coffee, bananas, stuff we can't grow here. Everyone said it was a retreat, right? That tariffs were just causing inflation.
Our sources say it was the exact opposite of a retreat. It was a strategic move.
Yeah.
They had to clear the decks politically.
What do you mean by that?
A tariff on coffee is just a tax on consumers. The U.S. can't produce, so it's what you'd call bad inflation. By getting rid of that unpopular tax, they gained the political cover they needed to deploy the tariffs that actually matter.
The ones on manufactured goods.
Precisely. The good inflation that's designed to hurt foreign competitors, not us at the checkout line.
And this whole strategy is aimed at a really deep economic problem, something Miran calls financial Dutch disease. Can you break that down for us?
Sure. In short, it's the curse of being the world's reserve currency. Everyone needs dollars for global trade, so demand for the dollar is always high.
Which keeps its value strong.
Artificially strong. And that's great for Wall Street. It makes imported goods cheap, but it absolutely crushes the Rust Belt because it makes our exports way too expensive for anyone else to buy.
So it encourages buying foreign stuff, not making it here.
Exactly. So the new tariff plan isn't really about collecting a tax. It's about using that tariff as a geopolitical lever.
And what's the end goal of pulling that lever?
The goal isn't just to make, say, China or Germany pay. The goal is to force them to the negotiating table. The strategy is to create enough economic pain blocking their access to the world's biggest consumer market that they have to agree to a coordinated strategic devaluation of the U.S. dollar.
A Plaza Accord 2.0, as the financial press is calling it.
That's the target. But until that happens, the immediate tool is what they call the FDI magnet, foreign direct investment.
And this is where the tariff money itself comes in, the revenue swap.
Exactly. Every dollar they collect from these tariffs isn't going to pay down debt. It gets recycled immediately to fund a massive supply-side stimulus.
So big corporate tax cuts, aggressive deregulation.
Especially in energy and finance, yeah. Plus, huge tax breaks for manufacturing. It basically turns the U.S. into what one source called a global liquidity vacuum.
Forcing a choice on global companies.
Very simple, binary choice. Do you want to keep paying a 20% tariff to sell your products into the U.S.? Or do you move your production here where you suddenly get Cheap energy, lower taxes, and this is key. You get to write off 100% of your new factory and equipment costs immediately.
So the goal isn't just to import the product, it's to import the whole tax base.
The factory, the payroll, the whole thing.
That makes a ton of sense. You're using foreign tax dollars, the tariffs, to subsidize the relocation of the foreign tax base. Okay, so let's pivot, because this links trade policy directly to immigration policy. And this is the second really unconventional pillar.
It is. Labor scarcity as a deliberate industrial policy.
Why are those two things linked?
Because the whole strategy depends on making capital-like machinery and factories cheap while making domestic labor expensive. For decades, the U.S. has been stuck in what's called the Lewis trap.
The Lewis trap. That sounds pretty academic. What is it?
It's actually really simple.
Ah,
We've had this constant, cheap, flexible supply of low-skill labor, a lot of it through high immigration flows. And that kept prices low for consumers, sure, but it created an innovation dead zone.
how so?
Well, if you own a factory, why would you risk $100,000 on a new robot with all the training and maintenance when you can just hire 3 people for $15 an hour with zero capital risk?
So cheap labor has been holding back automation for years.
For 30 years. And you can see it in the data. The U.S. lags way behind in robot density. We have about 285 robots for every 10,000 employees. China, on the other hand, saw its demographic cliff coming and mandated automation. They're now at 470.
They solved their Lewis trap with policy.
Which brings us to probably the most controversial part of this whole doctrine. Our sources describe the current crackdown on illegal immigration as more than just border security.
They call it a brutal but effective industrial policy.
And that is, that's a very blunt way of putting it. We have to look at this purely through the economic lens the sources are using. By cutting off that inflow of cheap labor, you are engineering a severe labor squeeze.
And spiking entry-level wages.
That's the forcing function. It's what economists call capital deepening. The cost of a human worker is now being artificially raised. So when that entry-level wage jumps to, say, $25 an hour, the entire ROI calculation for automation just flips on its head.
Ah, I see. Suddenly the math on that $100,000 pallet stacking robot looks completely different.
It pays for itself in 18 months.
And the government steps in to speed that up.
It turbocharges it.
Yeah.
That recycled tariff money we talked about. That's the hidden subsidy, the 100% capital expensing. So the policy makes the capital investment immediately cheap while making the labor cost immediately expensive.
Forcing companies to automate.
It forces the adoption of robotics and allows the U.S. to claw back strategic sectors, logistics, precision machining, that can only compete globally if they're automated.
Okay, this all hinges on one massive question, inflation. The standard critique has to be, if you make imports expensive with tariffs, ND, you make labor expensive with immigration policy. Shouldn't prices just explode? Where's the firewall?
Right, and Miran's doctrine has 3 powerful structural deflationary forces built right in to counteract that pressure.
Let's start with the one that's tied to the labor squeeze.
That would be housing deflation. The demographic lever. Miran argues, and the data backs this up, that housing and rent are the biggest drivers of that sticky inflation that the Fed has so much trouble controlling.
So by strictly limiting net migration.
You remove millions of units of demand from the rental market over the medium term.
And you can see that relationship pretty clearly in Chart 2 in the source material, which plots migration inflows against the shelter component of the CPI.
Exactly. Less demand means a powerful structural deflationary base effect in the overall inflation numbers. That gives the Fed a lot more room to maneuver.
Okay, what's the second force?
The energy dividend. The aggressive deregulation of oil and natural gas is designed to keep domestic energy cheap and abundant. And cheap energy acts like a universal tax cut. It lowers the cost of everything.
Transport, heating, running the factories themselves.
Everything.
And the third one, the Amazon wall, is fascinating because it's about consumer behavior.
It is. It leverages the reality of modern e-commerce. On a platform like Amazon, price transparency is absolute. Switching costs are zero.
Right.
So if a foreign company tries to pass on that 20% tariff by jacking up its price, the consumer instantly sees a cheaper domestic alternative right next to it.
So those companies can't just pass the cost along, they have to.
They are forced to eat the tariff cost out of their own profit margins. The tariff becomes a tax on foreign profits, not on U.S. consumers. The consumer basically becomes the inflation police.
Okay, this is a comprehensive, if incredibly aggressive, system But it's also a high-stakes gamble, so we have to talk about the failure modes.
Absolutely. The first risk is huge. They call it the valley of death.
A timing mismatch.
A classic timing mismatch. The cost of this doctrine, the higher wages, the tariff structure, they happen right now, immediately. But building a new semiconductor fab or battery plant, that takes 3 years.
So you have this huge high inflation gap. How do you pay the bills for 3 years while you're waiting for the new factories to come online?
You rely on the white-collar bridge. The physical economy is slow, right? Moving steel takes time. But the U.S. economy is over 70% services. The entire strategy is banking on LLM-based automation, providing massive and immediate service sector deflation.
So while the factory is still just a construction site, AI software is already cutting costs in offices.
Exactly. You see the potential for this in Chart 1, the productivity crossover. The bet is on a 15 to 20% cost reduction in white-collar work lawyers, accounting, customer service happening almost overnight. That productivity boom from AI is supposed to pay for the expensive transition in manufacturing.
Okay, risk number 2 sounds just as big. The AI safety net fragility. The whole point is to weaken the dollar by getting foreign central banks to stop buying our government debt. But that leaves a huge hole.
A massive hole. The strategy relies on a very delicate balance. While sovereign buyers, like central banks, are stepping away from U.S. bonds, private foreign investors have to keep pouring money into U.S. equities. They have to keep believing in the U.S. tech story.
Buying stocks like NVIDIA.
Buying NVIDIA, AMD, you name it. That flow of private capital into our stock market is what keeps the dollar from just crashing completely.
But the danger is a double sudden stop.
That's the nightmare scenario. What if the AI boom turns out to be a bubble? Or some geopolitical event spooks tech investors? Then you have foreign private money pulling out of our stocks at the exact same time foreign governments are trying to weaken the dollar. That double shock could cause an uncontrollable crash.
And derail the whole thing. Wow! Okay, the final risk. The one that keeps Treasury secretaries up at night. The bond vigilante revolt.
Right. What if inflation fears just get too strong and investors dump Treasury bonds, pushing the 10-year yield to 6, maybe 7%? The cost of servicing the national debt would explode and could choke off the real economy.
So how do you defend against that? They have something called a decoupling defense.
This is maybe the most sophisticated part of the whole plan. It's a mechanism designed to let the industrial strategy survive, even if the government's own finances are in distress.
How does that even work? How do you decouple corporate borrowing from government borrowing?
It's about the different types of debt. When a big company builds a factory today, a lot of that financing comes from private credit or floating rate loans, and those are priced off the short-term rate set by the Federal Reserve.
Not the 10-year Treasury yield.
No, that's for government debt. So if the Fed, which is focused on this industrial policy, keeps its short-term rate low to help manufacturers,
Then corporations can still borrow cheaply to build the factories.
exactly. Even if the U.S. Treasury is getting hammered and paying a huge penalty on the national debt, that corporate shield allows the industrial economy to keep growing and automating. The private borrowing costs are insulated.
And we're actually starting to see that in the data. In Chart 3, the spread split. The cost of private corporate debt is staying flat or even falling, while the government's borrowing cost is skyrocketing.
It's a system designed to put the government's balance sheet in the penalty box so the private economy can score the goals. It's an aggressive two-speed economy.
So let's wrap this up. The takeaway from this deep dive is that the Miran Doctrine is a truly high-stakes, unconventional gamble.
It's trying to force massive growth and automation, using tariffs as a magnet and labor scarcity as a tool. And it's trying to insulate that fragile transition with digital deflation from AI and cheap private sector credit.
The whole thesis really relies on creating this two-speed economy where private companies can borrow cheaply to automate and grow, while the public sector balance sheet just suffers under the weight of high debt yields.
It does.
So the ultimate question for you as you watch the economic news unfold is this. Will the growth generated by that corporate shield, the new factories, the automation, that imported tax base, will it be enough to overwhelm the rising cost of the government's own debt before the whole system breaks? It is a calculated race against time, and you now have the framework to track every second of it.